Hi everyone, this is Glenn Neely with NEOWAVE Incorporated, and I'm going to be going into part 2 of the introduction to Neely River theory today. The other one was recorded less than a week ago and sent out to my entire customer base and database, and then was posted on YouTube. This will be following the same process. I want to sort of quickly remind you of what the last video ended up with, so we can then carry on and get to the next phase of the discussion. In general, Neely River theory and trading technology is a way of dealing with markets and trading markets that is absent the concept of forecasting. And as I explained quite a bit in my private classes, the process of forecasting is really the primary reason most people lose money trading. Okay, they get so caught up with what they believe is going to happen, what they think is going to happen, what they hope is going to happen, that they stop focusing on the risks they're taking, the losses they're taking, and they're just letting the bad trades carry them away and carry their account away, and not spending much time on those, just hoping that the trades will turn around and come back, to positive. So river theory helps to redirect your thinking, redirect the trading process, get it off of the forecasting merry-go-round, you might say, and focus on what's really important, which is good entries, good risk management, good stop placements, good stop movement, good exiting strategies, which are all going to be founded on capital preservation and risk management. So let's review real quick where we left off the last time. The last discussion had talked about the 3 different zones of trading that take place both in a market, which are connected to the behavior of water in a river. So in a market, you have a north channel and a south channel, and prices moving to the right over time. And as a market approaches the upper end or the lower end of a objectively created channel using river theory concepts, you get turbulent price action near the top or the bottom, and more directional price action near the middle, just like you get with water in a river. More choppy turbulence near the perimeter of the river, the north and south bank, and more directional movement of the water near the middle. And then I showed you how this behavior can make a direct connection to wave theory. And it's the first example I've ever seen that actually gives you a visual understanding of why wave theory actually works and how it works and what the force is behind it. So this means that wave theory is actually a subset of river theory, because river theory explains why wave theory actually exists and why it works the way that it does. So these 3 these 3 zones of behavior, these market zones, can then be connected to the 3 types of buying and selling that you can do in a market. When most people, look at a market and think about their trading, they assume, well, the only thing I can do is I can buy or sell, and that's a pretty simple thing, and it's not too complicated, and that's it. All I have to do is decide whether I want to buy or sell. But things are a lot more complicated than that. There's a very complex world going on in markets, because it's not like a regular retail environment where you have a wholesaler who creates a product and sells to a middleman, and then they sell to a local retailer. It might be, the wholesaler is a national distribution center, the middle company is maybe in an individual state, and then you have the retail outlets in the individual cities. That's the way a regular retail world business process works, and it always goes from the wholesaler, works its way up. Each level, the next level up, is making a little bit of money off the transaction before they sell it to the next group, and that's the typical business environment. But when it comes to markets, there is no absolute wholesale or retail level. Everything's perception of what you think is a good price to buy or what you think is a good price to sell. So when it comes to markets, you actually have not a one-directional 3-layered phenomenon, but you have a 6 two-directional, six-layered phenomenon. So in a market environment, when you're buying, say, near a market's high, someone has to be selling to you who believes the market's going down. And so they would be considered, from their perspective, a wholesale seller, and you're a retail buyer. And it's happening at the same price, instead of it happening where the wholesalers are getting in at the better price and the retailers are getting in at a worse price. In markets, in freely traded markets, it's a horizontal phenomenon. So instead of it just being buying or selling, you have buying and selling on multiple levels and for multiple reasons, with multiple belief systems going on, those who believe the market's going up and those who believe the market's going down. So you actually have 6 realities taking place. And these are the only 6 realities that can ever occur in a market. You can buy near the high of a range, whether this is a daily bar, or weekly bar, or monthly bar. You can buy near the high of the range, or you can sell near the high. You can buy near the middle, or you can sell near the middle. You can buy near the bottom, or you can sell near the bottom. But the transaction, as I mentioned, is not vertical, it's horizontal. So those who are buying near highs would be those who think the market's about to break out and start a trend. So those would be the trend traders who are buying from those who are trying to pick a top and they're selling into this new high with the exact opposite belief of this group over here. And then you have those who are bargain hunters who, on this side, they think the trend is up, so they're waiting for the market to advance and then sell off and getting in around 50-60% retracement of the advance. And then those who think the market's going down, they may have seen the market top, sell off, and then bounce, and during the bounce they're looking to sell near the middle of the range before the sell-off resumes, and they put a stop near the high. And then you have the bottom pickers, where they're either getting in right at the beginning or they're waiting for the market to retrace dramatically 80, 90, 95% and buying near the bottom with a stop potentially at the low, or some just made up stop where they don't really know where to put their stops exactly. And then you have those who are selling into the new low, if it makes a new low, because they think the trend is down, and those would be the trend traders who are on the bear side. So these are the only 6 realities that can exist in a market. Those buying near the high, selling near the high, buying or selling near the middle, or buying or selling near the bottom. And that's it. And it creates these 3 zones of trading where the wholesalers who are selling to the retailers who are buying at the same price, are the mid-range or bargain hunters that are buying and selling in the middle of the range, and then the wholesalers and retailers who are buying and selling near the bottom of the range. So this creates 3 individual styles of trading, and these are the only 3 types of trading that exist in the world. You have top and bottom pickers. So if you're in an uptrend, they would be the bottom pickers. The bargain hunters would be those who are buying on 50-60% pullbacks of the uptrend. And then the trend followers would be those who are buying near the highs or into new highs. And if you're in a downtrend, then obviously it's the opposite process. So these are the only 3 ways you can trade, no matter what kind of system you use, whether you're using astrology or analysis of interest rates or moving averages or wave theory, or it doesn't really matter what it is. When you boil it down, when you enter a market, it's going to always be in one of these 3 styles. And it's based on generally the foundation of the system you're using. Is it a trend following system, a bargain hunting system, which is very commonly related to fundamental analysis, and our top and bottom picking kind of trading. Now, if you're in the top and bottom picking category, that's going to be closely related to a concept I call time. Now, I'm not going to explain in detail how that's figured out, but as part of the river class, I explained to you how to track the top and bottom pickers or the time traders, and it's an emotional kind of environment. It's a gut instinct. People are just sort of feeling their way into deciding a market's topping or bottoming, because if your market's been going up for a while, there's no way to know if that's going to be the absolute high. The only way you know is to wait a few bars or a few weeks or a few months until after the highs happen, and then you can look back and say, oh yeah, that was a high. But as the high is happening, there's no way to know if you're going to be right or wrong. So it's an emotional gut instinct kind of trading that can get you into big trouble if the market's in a good trend. If a market's in a consolidation, this kind of trading works fantastic. If a market's slowly drifting up or drifting down, then this trading can work, but your stops can be very large, and it can get very uncomfortable as you wait for the next phase of the up move or down move to take place. Now, the bargain hunting is more of a fundamentally oriented process where you're looking for the quote true value of a company or of a market or an economy or a house. It doesn't matter what it is, but you're looking for what you can qualify as the selling value. Or if you were to liquidate a company, this is what it would liquidate for. And so if the stock ever trades close to that amount, it's a safe buy. And that's typically going to be somewhere between the high and the low of whatever range has been traded over whatever period of time you want to pick. So if it's over a period of a month, the lowest low is potentially going to be undervalued, the highest high will be overvalued. The point in between is somewhere near, fundamental true value over some period of time. The process of figuring this out and deciding whether a market's in a bargain hunting environment is very complicated. And it requires us looking at markets in a very weird, unique kind of way based on retracements and the number of lows or highs previously broken in the past. It's one of the more difficult concepts for people to get in Neely River theory, but it's a very valuable concept to understand. And this concept is normally implemented by well-capitalized, successful traders, institutions, large funds that have a lot of money, and they're going through an accumulation of positions over a period of time or a distribution of positions over time. So this is generally safe for traders, banks, funds that have a lot of money to work with, and they have to phase in and scale in and scale out of positions. And then the last and easiest to understand is the trend trading group. And this is when a market, you've gone through a period of consolidation for a while, and you're trying to guess at which point that it breaks a higher low is the start of a new trend. And so you would be buying into the new highs or selling into the new lows. And this involves what I call price tracking. And price tracking is marking those points in on a chart where the trend traders would have jumped in, where they would have placed their stops, what kind of channeling trend traders use to channel price action when they're following markets, and then how they how they decide when it's time to potentially scale out of positions. So the Neely River process addresses each individual environment, and it deals with the specific way each of them trade, the specific way they enter, the specific way they place stops, move stops, exit positions, scale out of positions. So price environments are more of a diagonal channeling kind of phenomenon. And again, this channeling is done in a very objective, market-defined kind of way. It's not determined by the analyst at all. So it's not a subjective process at all. But the channeling is market-defined, and it's generally going to be at a diagonal. When you're dealing with a bias environment, this is more of a breakout accumulation distribution process. So your channeling is going to tend to be more horizontal, again, drawn in a very objective kind of way. And when you're dealing with emotional time traders, the channeling can be diagonal, horizontal, contracting, expanding. So it runs the whole gamut. And again, it depends on market-defined conditions to decide what kind of channeling you're going to use. And then you place that on the chart depending on who's in charge of the trend or who's in control of the trend. So that brings us into another important issue, is determining who is controlling the trend. And that's a very specific process, and it's a financial process. The people with the most money in a market are those that control the trend. And so as part of river theory, I've introduced a concept that I've never seen talked about before in other systems or other technology, where it involves what I call financial capacity. And the financial capacity of each individual trader has a big part to do with how they actually trade. If you're starting a new account, you don't have a lot of money, you're maybe trading with $5,000 and you're trading the futures market, that's barely enough to even open a futures account, and gold can move $1,000 easily or more in a day with one contract. So if you're trading the gold market with a small account, you may see the value of your account swing 20% or more in one day on a regular basis, which can be very emotional and very scary, and it makes it impossible to really properly manage risk. So there's 4 different levels of financial capacity. Oh, by the way, I forgot to mention the other side of the coin. If you're trading $1 billion, you're going to trade an entirely different way, an entirely different time frame. You can't hourly trade $1 billion. You really need to adjust your time horizon based on how much money you're working with. So the larger the amount of money, the longer the time frame that you're going to be trading. So there's 4 different levels of financial capacity based on empirical evidence. And most people know about weak hands and strong hands, but Neely River deals with 4 different levels, which is weak, minor, intermediate, and strong. And each one of them would be dealing with a different time frame. You could say that the weak hands are those who are intraday trading, the minors would be daily bar trading, intermediate be weekly bar trading, and strong would be monthly bar trading. And you'll see well, I'm not going to explain to you exactly how this is done, but as part of the class that I teach, it goes into the details of how to figure these things out and determine where each group is being stopped out or stopped in of positions, and how that affects the way they trade. So when you're dealing with the 4 different levels of financial capacity, you have the weak hands, which are inadequately capitalized. They tend to be very emotional because their account is swinging up and down so much in value so quickly. They tend to be indecisive, changing their minds a lot. Because of the small capital base, they automatically have to be taking a lot of risk. Then you move on to the minor hands. They might be somewhat marginally capitalized. They're inexperienced typically, and they're still over leveraged, even though the risk level may not be so extreme as the weak hands. Intermediate traders might be small banks, small funds, experienced professional individual traders, things like that. And then the strong hands would be those with excessive capital, international banks, multi-billion-dollar funds. Those environments tend to be very unemotional. They're very calculated in how they enter positions and manage risk and place stops. They're very decisive about what they do. They're very averse to risk. They typically would risk, 1% or so, maybe even less on a per trade basis. So that way, no individual trade actually destroys their, performance of their strategy or their capital base. So how does this work in the real world? Let's pretend that this bar right here is a monthly bar. And the market started down at this low, and it zoomed up really quick before almost anyone had a chance to notice. And this entire group will be dealing with the bullish side, not the bearish side of the equation. So all of these traders are bullish, and they're all trading different time frames because they all have different amounts of money. So if this is a monthly bar, let's say that everybody was a terrible trader and they're all trend followers, and they all got in at the worst possible time. They all bought right at the high, and they're all bullish. And the market slowly starts selling off. And somewhere around 25% retracement, if this were a monthly bar, the weak hands would start to be losing so much money they'd be forced out by their broker. They would just decide they can't stand the heat and they're going to get out. And what most people don't think about is that when the weak hands are selling to get out, they're not selling to somebody who's bearish. You can't sell to someone who wants to go short. You can only sell to someone who wants to buy. So as the weak hands sell to get out, they have to be selling to someone who wants to buy who's still bullish. So as the market starts selling off, the weak hands are going to be selling their positions, and they have to be transferred to someone else who is actually still bullish. And this would be the stronger buyers that are accumulating positions over time. And let's say the market continues to sell off. After maybe a one-day rally, it sells off for 1 week to here and then 2 weeks to here. So all of a sudden you get a 50% retracement, and the minor hands start getting very uncomfortable. They're losing too much. Their brokers may be forcing them out of the market. And as they sell to get out, someone again has to buy, and that's going to be shifting their positions from them to people with more money who can slowly accumulate positions. And then the last group would be, the last holdouts would be the intermediate hands who are selling maybe around 75% retracements, and they're selling again to these strongest buyers who excessively capitalized. They're going to have their stop one tick below this low, and they're going to be accumulating positions as far down as 99% retracement of this rally, with heavy stops down below this low. And so as it passes this point, more and more people get out, think the market's going down, they're selling, they're maybe selling to go short, and then the market starts pulling back up. And as it starts pulling back up, all these people who got out, and especially they break new highs, because we mentioned this particular group were trend traders, as it starts to make new highs again, well, they're going to want to jump back in because they think, oh, the trend really is up and I need to make sure I'm back in to catch the new advance. So they're jumping back in at the worst potential prices on a retail basis with really big stops. But that's the process of the way weak hands, miter hands, intermediate and strong hands are interplaying between each other. And the strong hands, of course, by definition, are going to be the group with the largest amount of money and the most patience and can withstand the most price movement against their position. So how can we track the behavior of each one of these types of traders, trend followers, top and bottom pickers, bargain hunters? Well, there's a very specific process of marking up charts to track all the individual elements that are taking place, where the trend traders are getting in, where the bargain hunters are getting in, where the top and bottom pickers are getting in, where each one of them is placing their stops, how each one of them is channeling the market. And then from all that information, when it's properly plotted on a chart using Neely River Theory technology, we can then determine who's actually in control of the trend. As you probably know, no one type of trading works all the time. You know, some systems are trend following systems, and most people sort of, approach the market that they're going to pick one of the types of trading systems and then just going to stick with it through hell or high water, through thick or thin, and just hope and pray. Eventually, the market starts to behave in a manner consistent with their system. So if they're using a trend following system, they know they're going to be chopped to death when the market starts going sideways, so they try to figure out ways to avoid those sideways chops. But if they're using a trend following system, it's going to be very difficult to avoid the consolidation periods. Then you have the emotional top and bottom traders who are jumping in at every high or every low, thinking they're going to, take a contrary position. And the way that they enter and the way they play stops is going to be different from the other group. And then you have the bargain hunters who are, taking their more patient accumulation distribution strategy, waiting for people to liquidate, get out of their positions at a loss, and they start, little by little accumulating all these positions over time. So each one of them is behaving different. They're all simultaneously going on all time frames and at all levels. Remember, we have buying and selling at the top, the middle, and the bottom. So all this is happening on a daily basis, a weekly basis, a monthly basis. So that simple chart I mentioned to you earlier where you can just buy or sell, and that's the only way you can impact market action is to be buying or selling, it hides this much more complex world that's going on, because the impact you have buying or selling is going to be based on how much money you have, how much buying and selling you're doing, where you're doing it, how you're placing your stops, and so forth. So river theory shows you how to track every individual element, all three different types of traders, where they're entering, exiting, placing stops, how they're channeling, and then figuring out from all that information who's actually in charge of the trend currently. So is this going to be an environment where top and bottom picking is going to work best? Is this going to be an environment where trend following works best? Or is this going to be an environment where bargain hunting works best? Because you have to know that information to make sure that you're entering and placing stops and exiting in a manner that's consistent with the market's behavior that it's going to have moving forward. And all that's determined by who's mathematically and financially in charge of the trend. The group that gets in the earliest in a trend is always going to be the group that is in charge, financially controls that trend. So river theory tells you how to figure this information out so that when you're trading a market, you're going to be trading it with the method and the style that's consistent with the behavioral environment unfolding. And it's the only system in the world that I've ever seen in 36 years that actually forces the trader to adapt his style of trading to fit the environment instead of trying to get the environment to fit your style of trading. But magnitude leap ahead of all the other trading systems that I've ever seen in my life. So let's just quickly review. The three elements of control of a market are time trading, which is top and bottom picking. It tends to be a very chaotic kind of environment, and it's not based on price movement. It's based on emotions and timing elements, and it's generally in effect near market tops and bottoms. Bias is a accumulation distribution environment that's instituted by well-capitalized traders, and it's usually associated in the early stages of the trend, not right near the top or the bottom, but after the top or the bottom has happened, and you go through the early accumulation or consolidation phase. If you remember that river graph, we have the turbulence near the high and the turbulence near the bottom. So this would happen right after you make the top or the bottom, and the market reacts and goes through the turbulent zone. That's when the bias phenomenon or the accumulation and distribution process begins. Then the trend traders are that group that is in effect toward the middle of the river. This is after the market's gone through its accumulation or distribution. It's moving out of its turbulent range and starting to move into the quicker zone of the river where price action moves faster. So this is where you're going to be buying into strength or selling into weakness, and it occurs near the middle of trends, and it is typically associated with acceleration phases. So that gives you phase two of the overview of Neely River theory. Obviously, I went into a little more detail about the different levels of a market and how they apply to the different types of traders, and whether you're a top and bottom picker, a trend follower, or a bargain hunter. Each level is going to relate to a certain kind of trader, and river theory goes into all of the details on how to figure all this out, how to plot out all the different trader elements that are going on at the same time, figuring out who's in charge of that trend, how to channel that trend based on who's in charge, and then you'll know how to actually trade that environment and how to enter and place stops. That's what river theory is all about. I hope you enjoyed this, and if you have any comments, please let us hear from you. Thanks a lot. This is Glenn Neely for NEOWAVE Incorporated.